Hi everyone. Normally I actually don't provide an update during the weekend, but yesterday I was live for about 2 hours and shared a lot of information, and in this video I basically want to summarize the live stream and also show some of the updated counts that I have, especially on the 1 hour time frame. So on a weekly time frame, this is what we're looking for. Nothing has changed for a very long period of time. We have the multi 1-2, the wave 3, and then the multi 4-5. So we're basically looking at some 4-5s, and after the latest 5, we look for a bear market to begin. The structure that I just showed you here is then actually quite similar compared to previous bull markets. So in the previous bull markets, you can see a similar structure. You have the 1-2s here with lots of overlap. You create a gap, then you get the 4s and the 5s, and then after the latest 5, you get the bear market. Same is true here for this bull market, even though I left out the first big 1-2 and the last wave 4 and 5. But inside this wave 3 here, you can once again see the 1-2s, the 3, the 4-5s, and after the 4-5s, you start to look for that bear market. So if we compare the current structure with the previous bull markets, then this is what you get from a simplified point of view. You have your 1-2s, you get your gap, and then you get those longer ranges again in your wave 4s and wave 5s. Now, of course, a wave 5 can be long, can be short. It just depends on the structure that we get internally, because wave 5 internally should be a 5-wave motive wave structure. Either an impulse, which is most common, 1, 2, 3, 4, 5, or you get an ending diagonal, but an ending diagonal is less common. So therefore, here we're looking for a wave 5, preferably in an impulse. Wave 5 can extend. It can be a long wave 5, of course, but that just depends on the structure that we get and the information that is going to be printed on the chart. At the moment, I would prefer to look at this wave 5 as a normal 5-wave structure, and then once a normal 5-waver is finished, the bull market is finished. But if we are going to see some crazy extensions and very, very high volume, then of course we could be looking for much higher prices and an extended wave 5. But it's a bit early to really give that the highest probabilities. And then I like to go to the daily time frame. On the daily time frame, you see the 886 Fibonacci on my chart, taken from this high to the low. The 886 is a Fibonacci that I found on my channel and is used a lot in my analysis because it helps with Elliott Wave probabilities. And the 886 has its own system. It's called the K8 principle, or Kuhn's 886 principle. And basically what it means in a nutshell is that when you're in an uptrend, right, you pull an 886 from the high to the first low, this structure. The moment an 886 is touched, the probabilities increase even more because for a very long period of time, we've been looking for price to sooner or later take out the all-time high anyway. But taking out the 886 or touching the 886 increases the probabilities even more to take out the all-time high, the high here, at a later stage. However, it is very common for the 886 to not be broken in one go and take out that high. You can see a beautiful wick here on the daily time frame, but the daily candle closed below the 886. And that is very common, as shown in my previous normal video, where I showed a couple of photos that I then posted in Discord of older 886s, where you can see the 886 being touched, then, sorry, wrong button, you get a little bit of a range or a retracement, and at a later stage you move back up. Now currently price here is ranging around the 886. It can range sideways and up, deeper retracement up, we'll see, but of course I have my 1 hour time frame scenario, so we'll jump to that in a second. It's just interesting knowledge to know the 886 is touched. And then we have the quote-unquote bearish scenario, which is a larger sideways structure and continuation up at a later stage. So here we have a W zigzag internally, A, B, C zigzag in either a wave X or B. However, the moment price would take out the all-time high, I am going to remove the W, the X, and the Y from my chart, and I will only have the A, B, and C. Because the moment you take out the origin here of this first structure to the downside, a flat becomes the highest probability larger corrective structure. So A, B, C flat, and after wave B, you look for an impulse 5-wave move down in wave C. Now wave B or X at the moment would be counted as a zigzag then in an A, B, and a wave C. Minimum flat target is touched to the 0.9 Fibonacci at 122.8K. And at some point, you want price to turn around and move to the downside impulsively on a high amount of volume. Now, the most common target for a wave B and a flat is actually higher. It's the 1.236 to the 1.38. The most common flat structure is an expanded flat, and an expanded flat wave B has this as the main target area, 128.6 to 131.1. But don't be mistaken that this is just your general B target area starting at the 0.9, which is the reason I put the ABC on my chart. If price would move towards the upside and touch the 1.618 at 135.2k, you're not going to be looking at longer sideways structures again. Instead, you're going to be looking at impulsive moves to the upside, right? Larger structures to the upside. And also, generally, if you do move beyond the 1.38 at 131.1, you got to start considering the probabilities decrease for scenarios such as these. But you always need a bullish and bearish scenario as an Elliott Wave analyst, and this is basically that bearish scenario. Now, you will see when we talk about the conclusion of this video, plus the other scenarios I have prepared, that having a retracement or looking for a retracement to come is going to be interesting. Now, the second scenario here is just a regular 5-wave impulse to the upside. 1, 2, 3, 4, 5. We like wave 3 to touch at least the 1.618 at 126k. Generally, wave 3 is extended, and this is a common target, or higher targets. Wave 3 extends even further. That is very normal. But looking at the subwave structure of this move up, I'd say like the 1.618 would be a nice target, maybe the 2 trend-based fib max, but not going too far when counting the 1 hour, which I'll show in a second. Now, in this case, though, we are also then looking for a retracement, but this retracement here should be a more sideways corrective structure and then move up. Wave 4 is not allowed to overlap with wave 1. That is an invalidation of an impulse, so we don't like to see that. So basically, price goes up, up, up. We don't want price to move to 117,998 or 118k and then still get another leg to the upside. Now, commonly, wave 4 is the same size as wave 2 in time, or longer, so that is something to pay attention to, and it will be very easy to recognize because you really want this structure to be lengthy, comparable to what we have here, and not compared to these one candle ranges here. So also here, we're then looking to finish an impulse to the upside, and then you start a range slash retracement, which is the same as here, because here you're looking for a wave C, which also is an impulse. It's the same structure, right? A 5-wave impulse to the upside, but after wave C, you look for a deeper retracement. If this impulse finishes, you're going to label it a wave 3, look for a retracement. So you kind of start to get a feeling of what happens once the impulse is finished. You look for a range or a retracement, no? Now then the most bullish scenario, same thing. This impulsive structure is the same in all 3 scenarios. I'm just giving you options or sharing options with what to look for and what to expect. Because in the bearish scenario here, especially if you take out this high, we're looking for a flat A, B, C. Wave C is an impulse down. So 1, 2, 3, 4, 5. It's a larger move to the downside. It's a motive wave structure to the downside. So, like in the bullish scenarios, by all means, you want corrective structures to the downside. For the Elliott Wave analyst, just short note, of course, wave Y, you can have like an ABC corrective structure and then create a flat. No W, X, and then a flat in a Y. But just to keep it a little bit simple, if you get a 3-wave structure to the downside, you're looking for price to take out that high in all cases as well. So the range or retracement that is about to follow, it will come. Once you get it, is it corrective or is it motive? Price never goes up in a straight line, never goes down in a straight line. At some point, you're going to get another range. Price moves up, range. Ups, creates a range. At some point, you're going to go sideways. Again, even when you get moves like these, price, big pump, at some point you're going to go sideways again, and you're just going to manage positions accordingly. So what I'm showing you here in this video is that once that sideways movement is going to start, the structure is going to be important. We'll analyze that on the channel. So here you want a corrective 3-wave move down. You look for a move up. That is your 5. In the most bullish case, 1, 2, 1, 2, this wave 2, 3-wave corrective structure, move up. Now, in an impulse to the upside here, right? Not that one. in this scenario, you don't want price to overlap with wave 1. 1, 2, 3, 4, 5. That's an invalidation. But in a multi 1, 2, you preferably see overlap between the lower degree wave 2, this one here, and the move to the upside in this wave 1. It is common to have overlap between the wave 1s and the wave 2s, similar to what you had over here for the 9K, the low, 1, 2, 1, 2, 1, and eventually you move towards the upside. It looks like a diagonal. It's not a diagonal. A leading diagonal is always lower probabilities than a multi 1, 2. And here you can see you have overlap all the time. Similar to the weekly time frame, just to use this as another example to get the point across. So just like what I showed you at the beginning of the video, these movements here overlap, overlap, overlap. Those are the 1, 2s, right? They're hidden in those structures. And then the gap, that's your wave 3. And then after the 3s, you get your wave 4s and 5s as you get the ranges once again. Also over here, if we are looking for the wave 4s and 5s, and you can see like the first range here was very long, this one is a little bit shorter in time. This one might once again as a wave 4 be a little bit shorter in time possibly. But of course that can happen, just like what we had over here. Long one, shortest one. So time, it can help, right? It can give an idea, the time element of Elliott waves. But time is never a confirmation or invalidation. Structure always comes first. So here we also get a retracement, but preferably you do overlap with this high at 118, which is the main difference between the two. Larger range, no overlap. Here, whoops, not that one. And here you also want a range retracement, but preferably you do have overlap. And in the bearish scenario, you preferably for sure have overlap and just move to the lower end of this range once again. And then we get to the, 1 hour. Let's go to the 1 hour time frame here. Now, previously on my chart, I had a multi 1, 2 over here, then 3, 4, 5, 4, 5, 4, 5. But what I did here is just keep it incredibly simple, because in both of the cases, if you're looking for an impulse to the upside, you preferably end an impulse on a lower amount of volume, not high volume, price moving up, volume increasing. For the bulls, you preferably get a wave 4 and a wave 5, another high on lower volume. As long as volume is going to increase for an impulse, you preferably still look for another 4 and 5 to eventually create a high on lower volume. So here, we then look for a 4 and a 5. Even if I would maintain the count of having a multi 1, 2 over here, what the hell, this is at the low, right? So if you would count the multi 1, 2 here at the low, which I had previously, it's the same thing, because then inside the impulse, you had a 1, 2, 1, 2, 1, 2, 3, 4, 5, 4, 5, get another 4, 5. You still preferably get another wave 4 and another 5, because so far the highest amount of volume is in the peak, which is fine for wave 3s, but preferably it doesn't happen in a 5. In a normal impulse to the upside, it's just less common. Now, wave Cs can end on a high amount of volume. Possible. But that does not mean necessarily in a C that it's the high is the exact candle with the highest volume. It generally means that the final leg up in C has the highest volume. So you have your 1, your 2, you get your 3, your 4, you get your 5. But inside 5, you still have a 1, 2, 3, 4, 5 structure. But then here, your 3 has the highest amount of volume compared to the other bigger impulses. And then still at the end of your C, you tend to then see a little bit of like this. So you have your 1, 2s in the final leg here to the upside. You have your 1, 2s, you get your 3 in C, and then you still get some 4, 5s, where on a lower time frame, you still get a couple more highs, but volume is slowly decreasing compared to this structure, and then you fall. So even here, like based on the local price action, currently the peak volume is in the absolute high, and it would be nice to get another 4 and another 5 to take out this high. Control Z here, or just click the bin. Take out the high, create another high on some lower volume. But wave Cs, sure, they can end on high volume, so we have to be aware. Wave C is also an impulse though. So yeah, 1, 2, 3, 4, 5, that would be the primary, what I'm looking for at the moment. That basically means that this range has to be a corrective structure. Now I like to give it a little bit of time. So wait for price to resolve itself locally. Keep an eye on resistances and support, which I will show you in a second. And then we'll get more information by just being patient. No need to think up front like this is going to happen. If this range is going to be a corrective structure, and we analyze that preferably on a 1 hour plus time frame, I prefer the 1 hour. So the moment that becomes very clear, sure, we look for price to move towards the upside and look for the wave 5. I mean, that's basically what then happens. Now the bearish scenario is a finished impulse. I basically already explained 1, 2, 3, 4, 5. 5 is now on the highest volume with the exact candle high being on highest amount of volume. It's just not preferred compared to having an impulse that is not yet finished. You still look for another 4 and a 5 to take out the high, finish 5, and then get the retracement. Just know your target area for 4,236.05 is common, 121k, 121.3k to 118.3k. Invalidation 618 at 117k, right? So then we get to the levels and then eventually the conclusion of the video and I suppose simplifying things a little bit. So on my chart here at the moment, these are the volume levels that I have. You can see the resistance 122.9, and then we have areas of support to the downside. Keep an eye on those levels. Then we have time frame horizontals, nothing going on here at the top at the moment. It's all down here. And then finally, we have the order blocks. Quite interesting. This is a 1 hour order block, if I'm not mistaken. Never wrote something here, but I believe this is a 1 hour order block. That's where we are now. We have a 12-hour order block over here, sitting between 120.4, 120.7, can act as support. Just double checking if that's in confluence with anything. Let's have a look. Might as well have a look while we record the video. Take a volume profile of this range. So we do have a value area high, point of control around that area. Of course, like when price is moving up, the previous ranges are going to be important areas of structural support. So it's always interesting to pull a little volume profile in those ranges. And of course, then we also have that order block there. And then we have some more order blocks all the way down here, but that's at the moment not very relevant. And then we get to the news. So let me refresh this here. Impact on 3 highest impacts. So today it is Saturday, the 4th of October. Here we can see that on Wednesday the 8th and Friday the 10th, we have some high impact news, 9 p.m. on Wednesday and 4 p.m. on Friday. Just make sure you trade safe. Of course, can increase the volatility on the chart. Not that we have any lack of volatility at the moment here, right? Beautiful, beautiful move towards the upside. And then we get to conclusions / probabilities. I suppose it's a mix of both. So probabilities on a weekly time frame, nothing changed. Like the people that are here for a longer period of time, by the way, thanks everyone for reaching 21K, insane. But the people that have been here for a longer period of time, they will know, like, on a weekly time frame, we've been looking for moves up for such a long time to eventually take out this high. That was the higher time frame directional bias for a very long period of time. We're almost there. Not yet. Maybe we're going to do it soon. Maybe not. Doesn't matter on a weekly time frame because the bias doesn't change. We're still looking for price to move up. So weekly time frame, highest probability, bullish continuation. Lowest probability is any bearish option. And that does not mean a larger sideways range. What I mean with any other bearish option is basically bear market, where this here is your tippy-toppy and you're going to be looking for much, much, much lower prices. On the 4-hour time frame, in all of the scenarios that I presented, and this is where I make things easy, in all of the scenarios, you basically aim to finish an impulse to the upside here and then get a retracement / range. The range or the retracement then decides what is next. Is wave C finished? Do we get a 4 or do we get a 2? You do not, and this is what I also highlighted in the stream, and I think this is sometimes a bit of a problem for Elliott Wave analysts. You do not need to know the exact Elliott Wave count per se. You need to know what you're looking for. Is a range more likely? Is a push more likely? Are the probabilities higher to move up or move down? You don't necessarily need to know what to move up is going to represent. Is it going to be a C? Is it a 3? Is it a 5? You just need to know what the directional bias is and trade according to that directional bias. If the probabilities are higher, as per some of the videos last week where I explained this as well, if the probabilities are higher for price to continue the local trend based on information of a new range, you're aiming to go long and trade that move up. And then based on new information that you get as price is moving, you can manage your trade accordingly. But you'll never, in the end, it's prediction, it's probabilities. You don't need to know, is this an ABC? Is this a multi-1-2? Is this a 1, 2, 3, 4, 5? It literally does not matter at all which one you give the highest probabilities, because in all of these cases, you preferably finish an impulse to the upside, a 5-wave structure, and then get a retracement. It's just the severity of the retracement and the structure that will decide what comes next. But it's important to realize this from a trading point of view, that if you're hanging around in your nice longs, which hopefully people are, and if you're not, just wait for a new range to form and stick to your plan. Don't get into FOMO and psychological stuff. Like, at some point, you're going to get another range and or a retracement, and in the more bearish scenario, you expect a deeper move to the downside. In an impulse, you expect a more sideways retracement to the downside, not overlapping with 118. And in a multi-1-2, you do like to see overlap with 118. Do we know upfront what's going to happen? No. Is there a way to basically assign some probabilities? Yeah, right. In a multi-1-2, this wave 1 is very long compared to the first one. It's not very neat that the lower degree one is quite long compared to the higher degree one, but it's not an invalidation. Very much works, so we keep an eye on it. And, there's more details and stuff, but in general, it just doesn't really matter. Right? Directional bias on a 1-hour time frame here, counting this move to the upside, would suggest that it makes sense to look for maybe another 4 and a final 5 up. Maybe your 5 is finished. Once you start moving into wave 4s and 5s, you generally look to end the structure, maybe take some profits or close, depends on your trading plan, of course, and then eventually wait for a new range, new retracement, observe what happens, and possibly join again. So I just think it's important to at least bring that message home and not be stuck to necessarily one idea and that's it, because there's so much more that you can be prepared for and not be surprised by what price is doing. But you can see that even though I have multiple 4-hour time frame scenarios, they're basically directional bias is relatively similar. Because, in the end, 5-wave move to the upside. Once finished, get the retracement. Retracement gives us the info. 1-hour time frame here. Now, for an impulse, you preferably create a high in wave 5 on lower volume compared to wave 3. With this in mind, seeing another wave 4 and 5, which is this scenario here, is preferred. If we get a deeper retracement now, be aware of it being a wave C and on a high amount of volume, because that can happen. And create a larger range on the daily, weekly. If this here is the high and we're going to drop, reach invalidation 117, be very aware of a larger sideways structure and upside at a later stage. So in a nutshell, the impulse on the 1-hour time frame, this one here, is likely in 4 5s. Finished, not finished, preferably not finished, but we're prepared for both. Meaning, the largest move of an impulse is likely finished, because that's commonly your wave 3. And therefore, we keep our eyes open for ranges and retracements, because those are interesting. The moment you move into wave 4s and 5s, the wave 4s are incredibly interesting. They can be very messy, but they're very interesting to observe. Once that range in a 4 is a higher probability corrective structure, you look to long a potential 5. Now, I say potential 5 after a 4, right? If corrective, you look for a 5 up. But imagine, and there you go again, the directional bias, if this corrective structure or if the range here is higher probability corrective, you look for price to move up. Initially, you're going to be thinking about a 5. But if price is going to increase in volume once again and starts to extend, well, we might still be looking for a larger wave 3. And that's how you adapt with your waves based on new information, but you're on the right side of the move. And that is most important. Higher probability corrective structure, looking to long it once price moves up and takes out the high, see what happens next and how to manage it. All right, that depends on your plan. So yeah, it's important for trade management. That's what I mean. Depending on the structure of the ranges / retracements, we will know more. So this is a 25-minute summary basically of the 2-hour live stream. It's still quite a long video actually, but I know that many people enjoy having a bit more information and me talking about stuff in a bit more detail as well. So yeah, I don't often actually upload on like during the weekend, but I think it was necessary. Like my latest video was Thursday. On Friday, I went live after I had a meeting with Robert Prechter. We had this move towards the upside while I was in the meeting, so I didn't even see it. And then the moment I ended my meeting with Robert, I saw the chart and I was like, ooh, looks like a good moment to actually go live. Yeah, we were live for 2 hours enjoying ourselves. But here you go. Got a video during the weekend. I hope you have a great weekend as well. And I'll see you again on Monday. So thanks for watching and subscribing. On the left side, you see a video on the simplest way to use and trade Elliott Waves without even counting. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott Waves. Thanks for watching and subscribing. And I hope to see you at the next one. Bye-bye.